Hello and welcome back to Strategy Desk. I'm Nandana Veerasinghe and this is episode 3. Today we are putting on our strategist glasses and reading one annual report end to end. Ceylon Cold Stores PLC, the company behind Elephant House, a brand every Sri Lankan household knows, when just turned a remarkable 160 years old. We'll move through the leadership narrative, the strategy itself, the numbers, the risk disclosures, and where the company says it's headed next. Before we begin, a quick note. Everything you are about to hear is drawn from Ceylon Cold Stores PLC's annual report for year ending 2025-2026. This episode is for information sharing and educational discussion of corporate strategy only. Nothing here is a recommendation to buy, hold, or sell any security, and it isn't a substitute for advice from a licensed financial advisor. With that said, let's get into it. Every strategic read starts with understanding what the business actually is. Ceylon Cold Stores PLC or CCS was founded in 1866, is part of the John Keells Group, and this report marks its 11th year of integrated reporting. Strategically, the group runs on two connected engines. The manufacturing sector makes the beverages and confectionery. This is the elephant house you and I grew up with. The supermarket sector is the Keells retail chain, run through JK Marketing Services. One engine builds brand loyalty, the other controls the shelf and distribution. That combination is worth remembering as we go through the rest of the report. Let's start with the headline numbers because CCS had a genuinely strong year. Group revenue climbed 17% to just over 184.6 billion rupees. Profit after tax jumped an even sharper 32% to 7.9 billion. Return on capital employed rose to close to 25%, and earnings per share moved from 6.27 rupees to 830. The market seems to agree too. The share price climbed from 80 to 203 rupees over the year. On paper, this is a business firing on multiple cylinders. But a strategist never stops at the headline. Let's dig into what's underneath these numbers. Digging one layer deeper into the financials, profitability improved on every measure. Return on assets and return on capital employed both rose because profit growth of 32% comfortably outran asset growth of 13%. Liquidity softened slightly. Both the current ratio and quick ratio eased back a touch, meaning working capital is a little tighter than a year ago. And on leverage, the debt to equity ratio rose from roughly 67% to nearly 77%. CCS took on more debt funded growth this year. The reassuring part is interest cover actually improved from 4.67 times to 5.20 times, so earnings are comfortably covering that added interest. Strength with a financing trade-off worth watching. Now let's zoom in on earnings per share because this is often the number shareholders watch most closely. EPS grew from 6.27 rupees to 8.30 rupees. That's up 32.4% year on year. Dividends per share rose in step from 4.30 to 5.67 rupees, while the payout ratio held steady at roughly two-thirds of earnings. Here's the interesting wrinkle. The price earnings ratio actually compressed from 13.08 times down to 12.41 times, even as earnings grew strongly. That's a signal the share price hasn't fully re-rated to reflect the stronger earnings yet. An observation, not a recommendation, but worth knowing as you read the rest of the report. Now to the leadership narrative itself. The chairperson's message tells a layered story. On the tailwind side, continued macroeconomic stabilization, record merchandise export earnings, recovering consumer sentiment in the first half, and robust remittance and tourism inflows. On the headwind side, rising import and raw material costs, electricity tariff revisions, and significantly Cyclone Ditwa, which struck at the end of November 2025, alongside global trade disruption from the Middle East conflict. Here's the strategist's read. A leadership message that acknowledges volatility alongside the wins is more credible than one that only celebrates. This one does both, and that sets the tone for how seriously the rest of the report treats risk. Now we move to the part of the report that should be the spine of everything else, the dedicated strategy section. CCS organizes its direction this year under the banner Steadfast, Steadforward, built on five pillars: sustainable growth, fulfilling the customer promise, empowered team, managing the value chain, and sustainable and responsible organization. What I like here from a strategist's share is that these pillars aren't decorative. They are tagged back to almost every initiative, metric, and risk disclosure throughout the document. That's a real test of strategic coherence. Does the stated strategy actually resonate through the rest of the report, or does it live in isolation on one glossy page? Here, it genuinely threads through. This is where we stop taking the strategy section at face value and check whether it held up under real pressure. Remember Cyclone Ditwa? A devastating climatic event with real loss of life and damage to infrastructure. The test is whether the sustainable growth and sustainable and responsible organization pillars actually showed up in the response. The answer is largely yes. Climate related risk was folded directly into the group's formal enterprise risk management framework, tracked across short, medium, and long term horizons, not treated as a one off crisis reaction. One caution for listeners: CCS states plainly it has not yet conducted a formal climate scenario analysis. Given how directly Ditwa affected the business, that's a gap worth watching in next year's report. The intent is there, the analytical depth is still maturing. Every strategy needs a board that actually owns it, not just approves it. CCS operates under the wider John Keells Group's corporate governance framework, built around accountability, integrity, transparency, and participation, with compliance triggers keeping standards consistent across every business unit in the group. This year's proof point: a significant group-wide systems migration onto SAP Signavio, completed on the 9th of March 2026, intended to improve data integrity, real-time performance visibility, and internal control effectiveness. The strategic read: governance here is tied to operational execution, not treated as a static compliance checkbox. Risk assessment: risk quantified, not just narrated. CCS runs its risk management through a formal enterprise risk management platform, reviewed quarterly, feeding all the way up to the John Keells Group Executive Committee. What stood out to me is how granular the disclosure gets. Take plastic and packaging: rising extended producer responsibility compliance costs and pressure toward recycled PET and circular packaging. Take data privacy, cybersecurity spend rising as the supermarket sector expands its digital and analytics platforms. Take food safety, traceability investment, and quality assurance programs at outlet level. Each of these is mapped with anticipated impact on cash flows and cost of capital across short, medium, and long horizons. That's exactly what the strategic lens asks us to look for: proof, not just narrative. Sustainability and ethics. CCS runs an annual materiality assessment, this year enriched by an external consultant's life cycle and value chain review. The resulting list reads as genuinely business relevant rather than box ticking. Macroeconomic resilience, workplace safety and inclusion, data security and digitalization, operational and resource efficiency, procurement practices and compliance, and good governance. And new for this year, climate resilience and disaster management was added as a material topic, a direct strategic response to Cyclone Ditwa. That's the materiality process doing exactly what it should, reacting to what actually happened to the business this year. On the stakeholder side, the group's engagement map is broad. Nearly 6,857 institutional and public shareholders, over 2.8 million Nexus loyalty customers, 8,429 employees, more than 100,000 distributors and retailers, and a supplier base exceeding 3,000, over 96% of which is local. What I would note for listeners is that the report doesn't just list these groups, it walks through a four-step engagement process: identify, engage, evaluate feedback, and respond through strategic interventions. That closes the loop the strategic framework asks for. Stakeholder input actually feeding back into strategy, not sitting in a separate section. So where does this leave us heading into next year? Capital expenditure on property, plant and equipment nearly doubled this year to over 10.4 billion rupees, a clear signal of growth intent. On the international front, Elephant House Ice Cream launched in Melbourne, Australia, the brand's first confectionery production footprint outside Sri Lanka. At the same time, the group is explicit that cost pressure, exchange rate sensitivity, and climate volatility remain live variables it's actively managing, not problems it considers solved. For a strategist, that combination, clear growth intent backed by real capital, paired with candid acknowledgement of what could still go wrong, is a more credible outlook than one that only tells a good news story. So that's Elephant House and Ceylon Cold Stores PLC through the strategic lens. A 160-year-old brand delivering genuinely strong financial results this year, built on a five-pillar strategy that shows up consistently across governance, risk, and sustainability disclosures, not just on the strategy page itself. The real test for the years ahead will be how the group builds out its climate risk analysis and whether steps like the Australian ice cream launch becomes a meaningful growth engine or stay a modest footnote. That's it for episode 3 of Strategy Desk. I'm Nandana Veerasinghe. Thank you for listening, and I'll see you next time with another episode next week. Good evening.